What is project finance? Project finance is more than just financing a project. It's a specific method of financing which has important differences to ordinary corporate finance. To illustrate the differences, let's look at a typical corporate financing setup. We have an established company with a number of existing assets and business operations. It's looking to raise funds for a new capital-intensive project. The company raises debt at the corporate level, and the debt obligations are then serviced by cash flows from all of the company's business activities. Now let's look at the project finance approach. The company first sets up a special purpose vehicle, or SPV. This is a holding company with the narrowly defined purpose of holding the new physical assets and their associated business activities. In a project financing, the debt is now issued directly to the SPV for the specific purpose of building out this new project. Once the project is operational, it's the SPV which pays lenders according to the terms agreed. If the SPV project underperforms, the lender has no recourse to company cash flows to recover its investments. This financing approach comes with certain advantages. The financing remains off the company balance sheet, and capital-heavy investments do not adversely affect corporate-level financials. If the project has strong economic prospects, this may allow financing on better all-round terms than if the funds were raised at corporate level. Higher targeted leverage may also be achievable through an SPV financing than fundraising at the corporate level. Unexpected liabilities from poor performance are contained in the project company. For specialist infrastructure investors, the SPV offers a clear and transparent definition of the project business and its holdings. This helps make it more transactable. That assists a common investor strategy which finances and builds the project before selling the completed operational asset at a premium to a lower risk buyer. Simple transactable structures can also reassure long-term investors that they have the flexibility to cleanly exit the investment at a later date. While an SPV financing has these advantages, it comes with a different set of risks. Every last cent of investor returns rests on the project performance. To complete a project financing deal, you need to convince investors to put up cash for a unique project with no prior operational history that still needs to be built and which offers no other source of cash if things go wrong. That's a lot of big convincing to do, and the answer to much of it lies with you. To win the argument, your modeling has to be very, very detailed. At least the construction period will have to be modeled on a monthly basis. The model usually needs to cover the full operating life of the asset, multiple decades. That's a long way from the 5 to 10 year annual cash flow models you'll be using to build pitches in investment banking. And if all that wasn't demanding enough, your work's needed to inform decisions made very early on, especially if you're on the sponsor side of the deal. Your model has to be flexibly engineered from the get-go, ready to handle a broad range of outcomes upfront, and be neatly amendable when the inevitable unforeseen changes do occur. This combined need for detail and flexibility sets the modeling for project finance apart and seriously ups the challenge. But we've made sure this course gives you what you need to learn and practice financial modeling at the major league level. So now you know a little bit more about project finance and the financial modeler's role, let's take a look at what you're actually going to build. This video is taken from the Project Finance Modeling course by Dealmaker. Get the full course today for a discounted price with this exclusive discount code. Just click the link below.